from here. Your thoughts?
Yeah, look, it's been a great start to the year, and the technicals have to be respected. What I'd say is on the upside, there's been far more surprises than what we've seen on the downside. So on the downside, yes, we've gotten some economic deterioration, retail sales, ISM, PMIs, all pointing to slower growth ahead. But on the upside, we've seen not only better inflation data, we've certainly seen better resilient labor markets. And then, of course, the whole story in Europe and China, that kind of came out of nowhere also, providing a little bit of comfort to markets. So the risk reward has been better for investors coming into this year. But what we would say is, have we gone too far too fast? We're certainly investors are gravitating towards this reopening, recovery play, high growth, more speculative parts of the market. But can this go up in a straight line forever? We would say as we get more signs and perhaps a bit of a confirmation of a potential economic slowdown, mild recession, or whatever you want to call it, markets will have to acknowledge that. But that being said, we do think that sets up for a better back half of the year.
Okay. Scott, I want to get your thoughts on this because at least in the near term, you're pretty cautious.
So I appreciate the comments regarding market technicals, and I think under the surface there are a lot of interesting looking stock setups on the heels of last year. But all told, when we look at the broader S&P sort of through our proprietary fair value lens, essentially as you move through 4,000 and you look at current S&P multiples, in the 18 or higher range, you begin to push where we think fair value is, given what we know or think we know about interest rates and the earnings outlook. So the point would be on technical, sure, you can run a little bit stronger as we have to start this year, but we think ultimately you do run into, let's call it a valuation headwind. That would be augmented, but what we think will still be ongoing earnings pressure as we proceed through the first quarter and into the first half of the year.
Scott, what about the thought that, you don't want to necessarily try to explain away the valuation situation. It is what it is. But, if you look below the very largest S&P companies at the more typical equal weighted forward PE, it's not as demanding. And then the idea that we were printing record earnings levels last year, most quarters, and we got a 25% pullback in the market. So now we're actually kind of beating earnings at a lower rate, and yet the market is on firmer footing. So are we looking at leads and lags there?
So I think we are, right? So a couple of points on this. So again, we like to talk about the composition of the index. So your top 6 weights in the S&P are 20% of the index, let's call it. Those are the companies that kind of typify that tech, communication services, consumer discretion, mega cap cohort that lagged so much last year. So it doesn't take much on the rate relief side to get a repositioning effect that plays through to the index. But to your point, I think among the things that we have to keep an eye on is that, last year, while the Fed was raising, inflation was rising or staying high, if you will. That ended up being a net positive for revenues and for margins. So we do have to allow that as we go forward from here in sort of a counterintuitive fashion, you can get inflation gradually coming off as we think it will. You might actually have this, again, counterintuitive negative impact on the way you think about the earnings trajectories. So all told, yes, lead lag effects are very clear. P is always going to lead E. We think there's probably still some more room to the negative on the E. But again, all told, a common view of ours for the past year has been, I think through this recessionary discussion, that earnings are going to end up proving more resilient than many expect for a recessionary type condition.
Yeah, we're starting to hear a little of that. I think it was, might have been JP Morgan last night, Mona, where they looked at claims and some of the inflation trends and said there might be some upside risk to our growth forecast. Do you think that view is going to become more common in the next 6 weeks?
It's certainly hard to ignore some of the better data we've been seeing. GDP, of course, more resilient. In a labor market like we saw, the jobless claims much more resilient than expected. This mild recession base case, could it prove to be just below trend GDP growth? That is certainly a possibility. But even in that scenario, markets would probably see a bout of volatility heading into that, especially after such a strong start to the year. Now, how we want to think about positioning longer term, though, is thinking about more balanced leadership going forward. We do think while defensive and value parts of the market have been lagging a bit this year, longer term, they may still make a lot of sense. Rates are not moving lower anytime soon. And this bounce we're seeing in tech, probably a bounce, but when we think about a longer term picture, more balance between value and growth. Think about bonds in the portfolio as well as yields move higher. So this is really a year to position yourself towards risk assets in a balanced way.
Okay. We'll leave the conversation there. Thank you both for joining us, Mona Mahajan and Scott Chronert.
Thank you.
As we go to break, watch Colgate today, beating on earnings and revenue, but stocks down 5%, actually gets down to $70 this morning. That's going to take you back to, say, the almost Halloween of last year. Margin did fall short, pricing up 12 points, but volumes down 2, while on pace for their worst day since April. Don't go away.